Good evening, everyone, and warm welcome to the webinar. My name is Neeraj Kotian, and I will be the moderator for today's session. I'm a part of customer interaction team at Quantum Mutual Fund. First of all, let me thank you all for taking out time on Friday evening and joining us for the session. Session will have approx 30 to 40 minutes of presentation, and then it will be followed by the Q&A. You all can post your questions in the chat box once the presentation is over. Topic for today's session, as you all know, is how India is placed surrounded by the global uncertainty. Here our speakers will answer the questions like, what are the indicators of global slowdown? What is keeping the Indian economy resilient? What is the potential impact on your investment portfolio, etc. Before we start, let me introduce you all with the speakers for today's evening. Our first speaker is Mr. George Thomas, who has over 6 years of experience in equity research across multiple sectors. He has been part of Quantum since 2016, and at present, he is the Associate Fund Manager for Quantum Long-Term Equity Value Fund and Quantum Tax Saving Fund. Our second speaker for the evening is Ms. Ghazal Jain, who has approx 5 years of experience in the field of finance and alternative investments, including gold, asset allocation, personal finance, and investment allocation. She is associated with Quantum since January 2019. Without taking much time of yours, we'll request our fund managers to take our this session. Over to you, Ghazal.
Thanks, Neeraj. Good evening, everyone. Thank you for joining. Before we dive into the macroeconomic situation and the outlooks for each asset class, we just wanted to quickly revisit the fundamentals of investing, and I'm sure you must have heard this term asset allocation from us very often, but it is repeated often because it is so important. So just to reiterate, our belief in asset allocation, if you see this chart, what we've done here is calendar-wise, we've tried to rank the asset classes based on their performance. And if you look closely, you'll see that the asset classes have gone through their ups and downs and pretty much moved in a cycle over the years. That is because different asset classes, in this case, we're talking about equities, bonds, and gold. They have different risk and return characteristics, and they respond differently, to the ups and downs and of the economy and how the macroeconomic situation is shaping up, right? So there are years when equity markets did well. There are years when bonds were the ones that were providing stability to portfolios, and then there were years when gold actually helped limit downside in investment portfolios, and typically these periods did not overlap. So just for instance, if an equity investor, in 2006 and 2007 was very happy with his equity returns, 2008, because of the shock, he saw a very big drawdown in his portfolio, right? So if he was invested entirely in equities, he would have really suffered. And on the other hand, if in 2008, after the shock, he decided to exit equities completely, he would have missed out on the rally that followed in the following year. So this is where asset allocation becomes really, really important. So on the next slide, we've just tried to simply put what is the role of each of these three asset classes in a portfolio. Equity is to boost returns. Debt lowers the volatility, gives you stable returns. And gold is like a portfolio diversifier, which tends to do well when other asset classes or the economy is suffering, and hence lowers your downside risk. So based on these three fundamentals, on the next slide, we talk about the 12-20-80 asset allocation strategy. We believe in this strategy because we have seen that this works over the years, in different market conditions. So what is this strategy? So 12 months of your monthly, 12 months of your expenses to be parked in a very safe and liquid avenue. It could be bank deposits, it could be liquid funds, right? This is your emergency money that you can fall back on, in times of crisis, in times of any sort of urgent expenses. Once that is taken care of, the rest of your portfolio you divide in the proportion of 20-80 to gold and equities. Equities, of course, like I mentioned, is for those long-term returns that your portfolio needs in order to, give higher than inflation returns over the years and increase your wealth. And gold is that portfolio diversifier that can help you limit the ups and downs that equity markets tend to see and give you a more smoother journey. So within this 12-20-80 asset allocation framework that we suggest, we give our investors two ways of going about it, the active way and the passive way. Of course, the 12 months of expenses can be parked in the quantum liquid fund because it is extremely liquid and extremely safe, and can be banked upon for your emergency expenses. Moving on, the 20% can be parked in the quantum gold fund or the quantum gold savings fund. And the third bucket, which is the equity bucket, can be divided. So if you look at the active allocation, there we divide it between the quantum equity fund of funds, the quantum India ESG equity fund to give you exposure to the ESG style, and 15% to the quantum long-term equity value fund to give you exposure to the value style. On the other hand, on the passive side, bulk of our equity bucket, we try to give you exposure to the quantum Nifty ETF fund of fund. This is a passive fund, as you're aware, and can be a good way to get your equity allocations if you would want to opt for passive style of investing. So if you, 12-20-80 is just a recommended asset allocation. You can customize this based on your needs and your goals. So if you visit our website, you will see that we have this calculator where you can choose whichever way you want to invest, active or passive investing. And you can, there's a calculator that I show on the next slide where you can put in your inputs in terms of, what are your monthly expenses, what kind of investment you're planning, and we can help you come up with, what your asset allocation should be, keeping in mind all of these things. So with this a quick, reminder of the fundamentals of investing, let's quickly move into the agenda for today. So I just like to start with, giving you a background of what is actually happening on the global front. If there's one word that can describe, the current macroeconomic or global situation, I think that word is uncertainties or uncertain, right? I mean, everything from, we have geopolitical tensions on the one hand with Russia, Ukraine, and China, Taiwan. We have the pandemic, which is still lingering in some parts of the world, especially in China, where we're seeing, they have a zero COVID policy. And both these things actually have had, negative or adverse impacts on supply chains. We're seeing an energy crisis play out in Europe. We are seeing commodities at multi-decade highs, right? And because of all of this, we've seen that central banks globally, are in a synchronized way actually sucking liquidity out of the system and hiking interest rates to tame this high inflation that we're seeing. Because of this sudden, in a way, U-turn of all the COVID era liquidity that they had provided, there are signs of an economic slowdown. And IMF, World Bank, and the leading institutions of the world have downgraded the outlook and the economic growth projections for the global economy. And because of this, as you're aware, financial markets have been going through a turbulent time. There have been a lot of ups and downs of late, a lot of volatility. US markets, for instance, are down 20% year to date. So uncertainties plenty. And with this background, I now request George to take us through where India is placed amongst this. George, over to you.
Thanks, Ghazal. So if you look at I'll start with how the basic composition of Indian GDP, where we can see it is largely contributed by the consumption and largely domestic consumption. Private and government consumption put together is almost 70% of our GDP. We of course have a reliance on exports, but that reliance on exports is well distributed between various sectors. So even if I look at the largest contributor to exports, which is the engineering goods, that's diversified between a lot of sectors. So unlike other developing markets, other emerging markets, which have very high reliance on a particular commodity, our markets have a slightly broader based linkages to the global exports, and therefore that impact of a slowdown in global growth could be minimal to that extent. More than that, the most primary factor is we are more a domestically consumption-driven economy. Of course, if the globe slows down, we would have impact. Our IT demand, IT exports could slow down a bit, but still largely, since we are reliant on the domestic consumption, we may not see the kind of slowdown which the other parts of the other emerging markets could see. And that is more or less reflected in the market performance as well. On a YTD basis, year to date, most of the global indices are in the red zone, whereas India is the only country where we are seeing a slight positive return. And if you look at the valuations, which is representative of the future prospects of a country, if you look at that, the red triangle is the current valuation multiples, and the green dots, they are the historic medians. So if you look at those valuation parameters, you can see even historically India used to command a premium compared to its global peers, primarily because if you take most of the sectors, we have a lot of room to catch up in terms of penetration, and we have a long headway for growth. So even the demographic dividend, where we see a massive amount of addition in the working age population, unlike other few Western countries where you would see a decline in those working age population. So all of that would benefit India in the long run. And as Indian economy develops, we have a long runway of 6.5% kind of GDP growth. And that's reflected in the resilient performance of Indian markets. So if I look at those drivers on what is holding India in the green zone, when of course the markets are volatile, because you would have an impact of the global uncertainty on the Indian markets as well, because foreign inflows are also a prominent factor. I'll come to the flows in a bit. But one of the primary factors which is driving the market is the strength of the corporate India. So pre-pandemic, India was around 2020, India was at the cusp of a recovery curve. Because of pandemic, we went through lockdowns, and there were high-touch industries where businesses were disrupted. Because of all that, we saw a short period where revenues and profitabilities of the companies kind of declined. And then post that, we have seen the recovery has only strengthened post the lockdowns. So if you look at the blue line, which is the net sales of corporates, that has been on an uptrend despite all these global factors, because we are seeing a continuation of that economic recovery cycle after many years of flattish growth for many years. And that's the reason you would see that blue line doing an uptick there. So even for the April-June quarter, where the recent data is available, the Indian corporates have recorded much higher revenues than they recorded in the past. Of course, the profitability has taken a slight dip, primarily because the input prices were on a rising spree. And corporates kind of gradually do a pricing, not to disturb the market parameters and the distribution channels and stuff. And that's the reason you saw a slight blip in the profitability. But if you were to look at the strength of the corporates, that has only strengthened in the last couple of years. So in terms of restoring those profit margins, as you can see in the slide, most of the commodities have kind of corrected from their highs, and even on a YTD levels, they're down for most of the commodities, except a couple of them where we have some geopolitical events which has covered those parameters. Like coal, Russia was a very high supplier, and those supply chains are not in place, still not in the proper place. Even gas, Europe was heavily dependent on Russia, and because of the geopolitical tension, the flow is not happening on a very smooth manner. But barring that, most of the broader commodities have corrected, including crude, and that would help corporates to restore their profit margins to historic levels. So if you look at the Indian economy, a few factors where we can gauge the economic strength of the country. If you see the capacity utilization of manufacturing units have crossed 75% after a very long time. So on the left chart, you would see that orange line crossing the 75 mark almost after 2019, where we saw the economy went through a downturn and the utilizations were kind of subdued. So what happens when the utilization kind of gets back to 75% is as the utilization nears an optimal level like 80%, corporates would put new capex, they would build new capacities, and that would initiate a cycle in itself of next cycle of economic growth. So along with that, we are seeing the credit growth kind of picking up. So that the blue line indicates the scheduled commercial banks credit growth, which includes the public sector banks and the private banks. So people are borrowing more. Corporates have deleveraged in the last many years. Despite a black swan event like COVID, if you see in the last couple of years, the corporate have actually strengthened their balance sheet. Their leverage ratio has increased the last couple of years, despite having passing through some such kind of pandemics and lockdowns, which we have never seen. So if you look at the commercial vehicle sales, which is another proxy for economic strength, even that has gained pace. So of course, in the last 2017 and 19, we saw certain new regulations like Euro 6, which came in, and that raised the prices of those commercial vehicles. And even there was some axle norm changes, which increased the capacity by almost 25% from a regulatory supportive point of view. All that is digested, and finally, we are seeing an uptick in the commercial vehicle sales, which will translate, which is indicating the amount of activity happening in the economy. And that is reflected even in the tax collection of the government, be it the indirect tax collection or the direct tax collection. So the GST collection has surpassed almost 1,40,000 crore for many months now. And that's indicating that the corporates are in a good state. They are able to sell their goods to the public, and that's resulting in more tax collection. Of course, there is an element of formalization as well in this one, where businesses are shifting to more productive enterprises, and even that could have a positive rubber for the economy. So even the tax provisions which the companies make based on the profits they earn, even that's showing a reasonable uptick, as you can see in this graph. So what all of these would enable the government is that would enable the government to continue its capex program. So it has enough money to spend on infrastructure development, road transport, and all of that. So if we look at a couple of parameters which is driving the economic growth, one of that is IT sector has supported very well in the last couple of years. Post-COVID, there has been a lot of demand for these IT services globally as well as domestically. Companies, enterprises have realized the importance of building digital systems, the importance of interacting with customers through online websites, and the capacity to serve customers were required to be increased multifold, primarily because a lot of people have started using those online systems and things. And that is visible in the IT salaries and the kind of hiring which the IT companies have done in the last few years. So if you look at the IT salaries in the last couple of years, that has gone up by almost about 40% kind of levels. And the same is true even in terms of the number of people working in the IT industry. And these are all very high paying jobs where the companies pay out almost 60% of their revenue as salaries to its employees. And those employees would tend to buy two-wheeler, they will buy a house eventually, and they'll purchase consumer durable products into their house and all of that. So that would have a lot of positive impact on the economy across sectors. So there are anecdotal evidences that one job in IT creates almost 4 jobs in other sectors. There should be hotels, hospitality firms that cater to demand of all of these new employees. So, and that kicks in a cycle of itself in the economy. So another factor which is driving this economic momentum is the uptick in real estate market. All of us saw the real estate prices have been kind of stagnant for many years now, from 2014-15. And at the same time, we saw the income levels of the citizens kind of rising on a 7-8% CAGR kind of levels. And what that has done is the affordability of those housing projects that's at multi-decadal high. So this is a data based on the actual customer data of HDFC Limited. And what you can see is, the average house property cost is just about little more than 3 times the annual income of its customers, which is a very excellent level. And we can expect that to continue in the near term, because property prices have remained stagnant. Even though we have seen slight uptick in property prices, the income levels have also caught up with those rates of hikes, and therefore on a relative basis, the affordability still looks quite good. So even if we were to see some bit of interest rate hikes, the EMIs might increase by 10-15%. But because of decadal high affordability, we could still see this housing property sales pertaining at these high levels. And that is quite visible in the data as well, despite multiple waves of COVID and all of that. We are still seeing, we are still seeing very good numbers in terms of housing sales across top 7 cities. And when we interact with our companies, and that's been the case with many cities across India. So one of the classic signs of an economic upturn is a continuous pace of earnings upgrade. So the analysts typically start estimating earnings 2 years prior. For instance, sitting in FY22, a lot of the sell side analysts, they would start projecting the earnings of what could pan out in FY24. And that has happened historically. So what you can see is historically, the estimates were at pretty high. So if you look at this orange line against this FY17, so the analyst started, against FY17, yeah. So the analyst 2 years prior expected the Sensex company's EPS would be something like 2200. And as the year progressed and when we finally landed to the actual EPS, it turned out much lower than that, around 1500 kind of levels. So this cycle of downgrade where the actual numbers have been lower than estimates, that has been continuing for a few years now. And post-COVID from FY22, as you can see in this graph, the actual earnings has started surprising analysts, and that is beating the estimates, which is a classic sign of a cyclical upturn. So, and that's the reason you would see that upward trending graphs in FY23, 24, and 25, where analysts are seeing that strength in the economy, and therefore they are forced to upgrade their numbers as and when the results are coming up. So if you look at the market valuations, markets are not cheap. It is trading somewhere around the average level. The sharp peak you see in this 2021, that's primarily because of the COVID lockdowns and pandemic. We saw the earnings were suppressed for a brief period, and that kind of resulted in high PE values. As and when this economic uptick has happened and earnings of the companies have improved, we are seeing those valuation ratios getting back to average levels. Right now, it's slightly more than the historic average levels, but since still the valuation is at reasonable levels. So one of the primary factors which has enabled Indian markets to stay positive despite all these global events, one, of course, is the strength in the domestic economy. And the second one is the domestic investors have evolved over the years. If you look at CY 2008, where we saw about $12 billion of FII outflows, the Sensex was down about 60%. And we saw almost more than 2x of that in 2022. A couple of months back, that number was close to about $28 billion, the FII outflows. And right now, with the inflows in the last couple of months, we are seeing that at around $21 billion. Despite that, Sensex has just marginally corrected in the current YTD 2022. So there has been a strong investment cycle which has come up from the domestic investors, and that flow is reasonably okay. The SIP book it continues to hover more than 12,000 crore a month compared to about 5,000-6,000 crore about 5 years back. And that is helping the Indian markets to some extent. So having said all these positive factors, of course, if you ask me if there are risks to the economy, there are risks to the economy. One, the larger companies are getting larger and the smaller companies have been losing market share in the near history. And because of that, though these small and medium enterprises, they do not have a sizable, they employ a large amount of the population, and their share of employment is much higher than what we could see in that economic share. And that could impact the consumer discretionary spend to some extent. And although the monsoon has been above average on a pan-India basis, the eastern and the northeastern belt have got deficient rains, and that's reflected in the paddy acreage deficit. The sowing has happened slightly about 5% kind of lower levels. But when we speak to leading tractor companies, we are still hoping at a marginal growth in those tractor sales, primarily because the produce prices have increased of all these commodities. And we had the base year sowing was slightly on a higher side. And like Ghazal explained in the first slide, the global world is seeing an interest rate hikes. We are seeing the after effects of massive stimulus which were rolled out post-pandemic, and that could slow down the global growth to an extent. But despite all these, the Indian corporates are staging a reasonably good recovery at the economic cycle. And therefore, and since India is more dependent on the domestic consumption, so even if we were to see a slight blip because of all these global factors, our recovery would be pretty quick because of the strong domestic linkages and the cyclical uptick which we are seeing in the Indian corporates. But the longer term risk for us is, so in order to benefit from the demographic benefit, we need to generate enough jobs. And between 2021 and 2055, we need to change the change in population, the working age population is almost about 136 billion, which is about 13.6 crore. And we need to generate enough jobs to cater to that demand. And if you look at the last 5 years, as of FY22, we in fact saw a marginal decline in the employed population. And that's a challenge which India would face for some time now. But despite all these, so equity investors should have a long-term view. So we recommend investors should at least have a 3-year horizon before they invest into equities. And if you look at history, we have seen multiple problems. Now, right from 1918, we have seen different kind of governments, coalition government, single party government. We have seen a lot of global upheavals. We have seen recessions in the past. Despite all of that, India has been able to grow at something like 6.5% across many decades in the past. And we believe that's likely to continue even in the future. So how this would have a bearing on your investment returns? So if I were to make a very simple math, so if I assume India's GDP would grow at 6.5% in real terms, and the inflation is likely to hover around 5% on a long-term basis. So if the nominal GDP grows by about 11.5%, we can assume a typical company can also grow at a very similar rate of 11.5%. So if companies which are larger, which are listed in index, which is better than a typical company, we can expect a growth of 13.5% because there would be market share gains. There would be innovation, which is done by the management over many years and things like that. And if it's an intelligent portfolio where we kind of identify sectors which are likely to do better and identify better companies, investors can expect a 15% kind of return over a very long horizon. So reiterating the point, what Ghazal introduced in the initial slides. So it's fairly important to have an asset allocation framework for investors, primarily because equity may not do well in all the years. There could be periods of global uncertainty where gold would shine better than equity. And therefore, it's important for investors to maintain an asset allocation framework where you have 12 months of your monthly expenses in a safe fund where liquidity should be the prime factor. And that could be a liquid fund or a savings account balance. And the balance fund, you can allocate between equity and gold in a ratio of 80-20. So gold would act as a portfolio diversifier in times when there is global uncertainties where equity is doing bad. You can expect a reasonable return from that. You can expect gold to kind of reduce that volatility. So we in fact did a study in the past on how this 12-20-80 would perform in terms of the returns. If we figured out, we did this a couple of months back against the Nifty 10-year CAGR of about 14.5%. This portfolio would have returned about 12.5% kind of return. But the good part was the drawdowns were much lower, whereas the Nifty 100% Nifty portfolio saw about 38% kind of maximum drawdown. This portfolio saw only 30% of drawdown, and the standard deviation was almost 25% lower. So this framework would help you to tide over an uncertain phase. So now I'll come to how to allocate that 80% bucket of equity. There could be periods when different styles are in favor. There could be periods when value is in favor. There could be periods when growth is in favor. So it is important as investors to have a basket of funds so that you can have a balanced experience across a time horizon. So the typical allocation which we would recommend investors is 70% of your equity allocation to quantum equity fund of funds, which is a basket of funds managed by other mutual funds. And Ghazal will talk in detail about that product. And the rest 30% you can split between Quantum India ESG equity fund, which invests based on ESG parameters, and 15% can be allocated to Quantum long-term equity value fund. So the Quantum long-term equity value fund that has a long track record of more than 15 years. It follows a value style of investing where we try to buy companies at a discount to its intrinsic value. And when you buy companies at a discount to its intrinsic value during market downturns, you would see the drawdown to be much lower because the companies which QLTVF for the Quantum long-term equity value fund holds are less than their fair prices, and therefore the fall would be lower than a typical stock where a lot of growth assumption is baked in. And when you look at a fund, you should evaluate in terms of the metrics, if what the fund speaks and what it practices are kind of similar. So in Quantum long-term equity value fund, there are the main criteria in terms of selecting stocks in Quantum long-term equity value fund is one, we look for fair governance practices. We avoid managements with short charge investors or kind of divert the earnings of the company just for the benefit of promoters without sharing it with the minority shareholders. Number two, we follow a strict liquidity criteria. We buy into companies which has a minimum daily turnover of about $1 million. So that would ensure even in an uncertain time when market is falling or market is rising, our buying or selling will not have a very high impact on those stock prices. But if I get into illiquid names, if the market is falling and when the fund manager starts selling, you would see his action of selling would also have a downward pressure on those stock prices. So and that's the importance of getting those companies with good liquidity. And the third parameter is we buy into companies at a discount to its intrinsic value. So, and that's reflected in this valuation ratio of Quantum long-term equity value fund, where Sensex has a price to earnings ratio of about 18.8. QLTVF has a price to earnings of about 13%, which is at a much discount to the Sensex. The earnings CAGR for the next 2 years based on consensus estimates, which is the estimate which is polled by the sell side analyst for QLTVF is about 13% compared to about 16% for Sensex. But the valuation adjusted for growth, which is marked by the PEG ratio, QLTVF is attractively positioned at about 1x compared to 1.15x of the BSE 30 index. So as I explained, we are we are looking at a cyclical uptick in the corporate sector and the economy, and therefore our portfolio is positioned to benefit from that. The large weights are in financials, consumer discretionary, and technology sectors. And in the coming slides, I would explain why we are positive on these sectors. So if you look at the consumer discretionary basket, most of that is dominated by Indian two-wheeler OEMs. And where if you can see the volume, the domestic volumes which we sold in FY22 were almost similar to what we did in FY12. So clearly there has been a delay in terms of that replacement cycle. If we assume a replacement cycle of 8-10 years, so the current demand would just cater to those replacement demand of what we sold in the last in FY12. And added to that, over the last few years, there were commodity pressures, there were input cost pressures. So companies have gradually taken price hikes. And despite this declining trend of sales, the profitability per vehicle has improved for most of the leading OEMs. And added to all of that, they have added their capacities. So the utilization levels have declined over the last few years, and a couple of OEMs are operating at just about 50% kind of levels in terms of utilization. So as and when as the demand kind of picks up with the uptick in economy, plus you would see that input costs are also easy. So you will see the benefit of leverage, the margins improving, and even the top line would improve. So even with the easing of these mobility restrictions, a lot of companies are still work from home, and they are going to adopt a hybrid model. So even that mobility would have an impact in terms of the two-wheeler demand. So the other large weight which we have is financials, almost 35% of the weight. So if you look at the Indian banks, they are at one of the burst shapes. We have seen them in the last decade. So their bad loans are in a declining phase, which would require them to give lower provisions, and therefore you would see higher profits. And despite that, the credit growth is also picking up with this uptick in economy. And the good part of that credit growth is, some part of it is of course led by the inflation and let's say the working capital, higher working capital, which is required because of higher commodity prices. We are seeing good growth even in retail credit. So the recent data point which was displayed, it showed the credit growth of almost 15%, and where retail credit growth, which is the credit demand by individuals, that grew higher than those broad line numbers. And despite all that, the valuations are around the fair zone, and therefore we are quite bullish on this financial space. So if you look at the performance of Quantum Long-Term Equity Value Fund, so the recent past 4-5 years has not been very supportive for us, primarily because value was not in favor for a good part of that. So despite having a lower earnings CAGR compared to those indices, so we were seeing massive discounts for those value stocks compared to those growth stocks, which reported marginally higher growth numbers. And that was one of the highest in those the recent past years, and that reflected in the performance. But YTD this year, that recovery is happening, and we have some bit of outperformance on a YTD basis in 2022, where we are going to see a broad-based economic recovery and credit cycle kind of normalizing. In that kind of a scenario, value is likely to do well. So with that, I'll take a pause here, and Ghazal will take us through the other funds from here on.
Thanks, George. So now coming to the next component of the 80% equity bucket, the Quantum India ESG Equity Fund. ESG, as you all know, stands for environmental, social, and governance. So this fund invests in companies that not only prioritize their bottom line, but they prioritize the triple bottom line, which is planet, people, and profits. That is because more and more evidence is suggesting that sustainable companies are actually going to be or will accrue the benefits and will be profitable going forward. So sustainability is equal to profitability, and we believe this is the future of equity investing. So a little bit on how we go about this fund. So we are banking on sustainability as the driver for long-term returns, like I said, and we have an in-house proprietary ESG process where we study and analyze businesses on each of these three parameters, and then take a call on whether or not you want to own them. But only ESG is not our focus. We also take into account the financial stability of the business, because for long-term returns, the financial stability, its performance on the ESG front, as well as liquidity. A combination of all these three is what we feel will be able to give good long-term returns. So on the next slide, we talk about the sectors that we are overweight and underweight on, and you can see that they are very different. Or there are a lot of active calls that this fund takes based on the ESG scores primarily, and market cap is not what is driving our selection here. So on the next slide, if you see, our trailing 12-month PE is 31.1, which is more expensive compared to the benchmark. But if you adjust that for the earnings growth of our underlying stocks, which for our portfolio is about 25% compared to 16% of the benchmark, we are a more cheaper, we are more better or reasonably valued. And that is an indicator of how we are going to perform going forward. The earnings profile looks very robust going forward. Of course, quality comes at a price, quality comes at a premium, and that is why the PE looks higher. But when adjusted for the growth prospects, we're very reasonably valued. Coming to the performance in a since inception basis, the scheme has given a return of 18.9%. It has outperformed its benchmark. Moving on to the next component of the 80% equity block is the quantum equity fund of funds. Why do investors choose equity investing through the mutual fund route? It's because they have no time, inclination, or expertise to analyze and select stocks. They want to outsource this to experts. But with the number of equity funds that are available these days, even choosing an equity scheme has become a complex decision, right? So that's where the quantum equity fund of fund actually comes in. So what this fund does is, based on extensive qualitative and quantitative research, we go through schemes, we subject them to hardcore number crunching, detailed analysis. We meet the fund manager, try to gain valuable insights from one-on-one interactions with him, and try and choose a basket of equity funds, which you can invest in, which have a good performance track record and can perform well going forward. So because this fund is professionally managed in an unbiased way, the risk of wrong selection of funds can be reduced. Single manager risk is eliminated because your money is exposed to diverse fund management styles, right? You can gain exposure to a diversified basket of equity schemes with very limited capital. So for example, if you want to invest in 5 schemes, and assuming they all have a minimum investment amount of 500 rupees, you need 2,500 rupees to get a diversified exposure to 5 schemes. In comparison, you can come to the quantum equity fund of funds, and with just 500 rupees, you get exposure to those 5 schemes. So that's the kind of benefit we are giving here. Also, one other important thing is that the fund reduces the hassles of making and tracking multiple investments. You just have to check one single NAV. So moving to the portfolio, just to give you an insight, even though we are owning funds, we wanted to know that the underlying portfolio, of course, is a diversified portfolio of stocks. Currently, the fund has an underlying portfolio of 200 stocks. Top 10 stocks make up about 35% of the portfolio. So not very concentrated funds, well diversified funds. Even in terms of market cap exposure, there's a breakup of 65% large cap and 30% mid and small cap. So even on the market cap basis, there is diversification. And if you see our top 5 sectors of the latest portfolio, we are into automobile and capital goods and financials. The portfolio is looking at riding this economic recovery wave that the country is seeing, and hopefully going forward, the performance will really benefit from this. So on the next slide, quickly, again, the historical PE ratio of the fund looks a little expensive compared to the benchmark. But if you adjust that for the earnings growth of the underlying stocks, the fund is better valued than the benchmark. And the earnings profile looks good going forward. On a since inception basis, the fund has outperformed the benchmark with a 13.76% return. Moving on to the next block of the 12-20-80 framework, which was the 12 part of it, wherein we keep our 12 months of expenses in a safe and liquid avenue. So here we talk about the quantum liquid fund. Now this is a good choice. This can be a good choice for your 12 months of emergency expenses, because this fund invests only in government and quasi-government securities with very low duration, which means it tries to minimize credit risk as well as interest rate risk, right? And can be a reliable way to park your near-term savings, your emergency funds. And so just to give quickly on the next slide, a quick update on where we see, debt markets. Even though the Federal Reserve and other central banks globally have been tightening, we see limited direct impact on Indian bonds from this, because FPI holding in Indian bonds is low. But of course, closer home, we have the Reserve Bank of India. RBI is likely to adjust its policy rate higher in spite of moderating domestic inflation. And that is, of course, because they have to keep the currency and bond yield differentials, compared to global economies. They have to keep that under control. So we expect long-term bond yields to, trade in a broad range of about 7.1 to 7.6, 7.7%. So the long end of the yield curve is vulnerable. Short end of the curve will likely move higher in line with the repo rate. So by year end, we expect it to go up to 6%. So all in all, this risk of yields moving up could spur, some volatility in debt markets, and that's where we think investors can opt for lower duration funds like the quantum liquid fund to minimize the impact of negative price changes and enable the continuous deployment of their money at higher rates in this rising interest rate environment. On a since inception basis, the fund has given a return of 6.75% in line with the benchmark. Moving to the next block of the 12-20 framework is gold. So we have the quantum gold ETF and the quantum gold savings fund, which invests in the quantum gold ETF. These are two ways you can take exposure to this asset class. The only difference being that the gold ETF require a demat account, and units of the ETF can be bought and sold like securities in the exchange. Whereas in the gold savings fund, it's a mutual fund route of taking exposure to gold, and you do not need a demat account, and you can use the SIP way to invest in gold in a systematic, disciplined manner. So just quickly, a few features about the quantum gold ETF. First of all, we take care of the purity aspect, because the ETF is backed by 24-karat physical gold. Unlike physical gold, there are no making charges or retail margins that are involved. So it's very price efficient. It's also price efficient in the sense that it transfers the benefit of wholesale prices to retail investors like you, because we as a fund buy the gold in bulk, and because of that we enjoy wholesale prices, which then the benefits of which are passed on to you. The fund is extremely liquid. Like I said, units are traded on the exchange. You can buy and get in and out as and when you want. And another thing that drives its price efficiency is that these units trade on the exchange very close to market price of physical gold, and there's very thin difference between buying and selling price. So coming to the outlook on gold. What we've been seeing of late is that there have been headwinds for gold, very clear headwinds in the form of the Federal Reserve, which is the central bank of the US, tightening big and tightening fast. That has resulted in high interest rates, stronger dollar. These two things are fundamentally negative for gold. But on the other hand, we've also seen some tailwinds in the form of inflation, like we discussed, is at multi-decade highs. Thanks to the war, thanks to the climate shocks, thanks to the supply chains that are still recovering from the pandemic, right? And because of the aggressive tightening that we're seeing by central banks, there are concerns of an economic slowdown or even a recession for the global economy coming up. So all of this has led to some sort of risk aversion, and we're seeing a lot of stock market volatility. So a lot of push and pull between these factors, keeping international gold prices range bound. And in the near term, we see there could be some downside, little bit more downside, but it will be limited because most of the price hikes by the Federal Reserve have been sort of priced in. If we take a medium to long term view, there are a couple of scenarios which we think can play out. The most likely scenario is that the Fed, of course, prioritizes fighting inflation over growth and tightens aggressively, and at the same time the global economy slows. So a recession or even a stagflation where inflation stays high and growth slows down, that kind of an environment is very good for gold. I mean, historically it has been supportive of gold prices, and this is the most likely outcome as of now. So that will keep gold relevant. Another thing could be, the Fed might slow down its tightening, or because maybe they get concerned about global growth, and as and when they do that, again we could see interest rates going down, and that will be positive for gold. And the third scenario, which is less likely, is a soft landing per se, wherein the Fed succeeds in not only bringing down inflation but also maintaining, not hurting growth. So in that case, yes, we could see gold prices taken off, but that scenario is very unlikely. The first two scenarios is what we see happening. And just quickly, because there is this perception that gold hasn't been doing well, recently through this turmoil of 2022, equity markets have seen so many ups and downs. But just wanted to, put it out there that it is the best performing asset class as of August, 2022 year to date, with 6.5% returns compared to equities, which have been about 3.5%, bonds that have been close to 1%, silver that has been given negative returns, and cryptocurrencies as well. So gold has really proven itself, as that portfolio diversifier that we're talking about. And coming to its performance in a since inception basis, the quantum gold ETF has given a return of 9.43%. So quickly to coming to the end of this presentation. Of course, we've established why asset allocation is important. We have given you, a DIY strategy, the 12-20-80 strategy that you can consider. There's another way of going about this asset allocation. If you're looking for a ready one-stop solution, and also if you think, you have a low appetite and would want a more conservative allocation to equities. So we have this offering called the Quantum Multi-Asset Fund of Funds. So on the next slide, we talk about its allocations. In this fund, debt and equity allocations range between 25 to 65%. It's dynamically managed based on what asset class valuations are looking like, what the market dynamics are. So we take a call on that. About 10 to 20% of gold. This fund takes exposure to these underlying asset classes through the quantum funds. So for its gold exposure, for example, it invests in the quantum gold fund. For its debt exposure, it invests in the quantum liquid fund and dynamic bond fund, and so on and so forth. So quickly, just to tell you what value this fund can add to your portfolio. Of course, it diversifies across asset classes. It's a ready-made asset allocation solution, reducing dependency on any single asset class, right? You don't need to time the markets. We do that for you. So you can just, invest in peace, right? We also follow regular rebalancing approaches. Just to give an example of how dynamically this fund is managed, if you see the chart on the left, when right before the COVID crisis, our equity allocations in this fund were running around 25%, because our model suggested that markets were overvalued. And when we saw the COVID crash of in March and April of 2020, the fund increased its allocation quickly up from 25 to 50%. So, we really took advantage of that crash and those lower prices and the reasonable valuation of equities. So that's how the fund is managed. And one last thing, it is an asset allocation product, and it is in fact a very, it can be a good alternative for those, who are looking for alternatives to bank fixed deposits, who want to get a flavor of equity investing without taking on, too much risk. So this fund can give you market linked returns, right? But with not too much risk. It can give you higher returns than fixed deposits though. So if you see the graph on the right, we've tried to plot the fund's returns, which is the blue line, versus the fixed deposit returns, right? And you can see close to 90% of the times, the fund has given higher returns than the fixed deposit. So this is one alternative you can consider. The performance of the fund on a since inception basis has been really good at 9.24% CAGR. Lastly, because we had spoken about the passive asset allocation strategy, just want to take you through our, the main offering there, which is the Quantum Nifty 50 ETF Fund of Fund. So what is this fund actually? We have the Quantum Nifty ETF, right, which invests in the top 50 companies or invests in the stocks of the Nifty 50, right? Now, the Quantum Nifty 50 ETF Fund of Fund is a wrapper around this, right? Because to invest in the ETF, you would require a demat account, and that does not also give you the, the option to do an SIP. We came up with this fund to give our investors the convenience of, being able to invest in equity markets in a disciplined way via SIP. And, you will not need a demat account as well. It is India's first Nifty 50 ETF Fund of Fund. Here we are trying to, give you the efficiency of ETF as well as the convenience of a mutual fund. And this can be a good way to, take equity exposure in a passive way. So with that, I think we've come to the end of the presentation, and now we can open the floor for questions. Back to you, Neeraj.
Thank you, George and Ghazal, for the insightful presentation. We'll request all our listeners to post their questions in the chat box. In the meantime, we have already received few questions via email before the webinar. So we'll start with that first. First question, George, to you. Like we started our presentation talking about 12-20-80 asset allocation solution to our investors. So will our 12-20 asset allocation plan differ as per changing geopolitics and economic conditions?
Not really. The asset allocation will help you in terms of achieving your long-term long-term investment goals. So if you have any goal which is less than 3 years, our advice would advise for you would be to stay away from equities and focus on fixed income products. Or even multi-asset fund where the risk profile is fairly less. But if you have a long-term horizon, anything beyond 3 years, this 12-20-80 would help you in terms of getting a flavor of those equity-like returns. At the same time, the 20% allocation would ensure the portfolio's risk is substantially lower than a pure 100% equity portfolio. And what that 12 months of expenses which you set aside in this 12-20-80 formula does is, so you will have a safe liquid money where in terms of any exigencies which you can access. So let's say in March 2020, when the market tanked, you had an emergency requirement, you lost your job. You need not alter your long-term portfolio to meet those immediate needs. You can get into those liquid money which is available immediately to you, which is parked in a liquid fund or a fixed deposit or savings bank account. And that would ensure your portfolio continues to achieve those long-term targets. And in terms of lower allocation to equity, the risk is on a longer term horizon. There is no class like equity which can help you generate returns which beats inflation on a very safe manner.
Thanks, Josh. Thanks. Ghazal, next question to you. In the current market environment, what role does gold play in an investor's portfolio? Is it time to increase allocation to gold?
Yeah, thanks, Neeraj. So while Indian equities are well placed with strong fundamentals and attractive valuations, they are vulnerable to the Federal Reserve's policy tightening and a global economic slowdown. So, and on the other hand, the prices of precious metals like gold will be supported by geopolitical tensions, the risk aversion, overall commodity inflation, and this could potentially cushion portfolios from the equity market volatility. So as such, I would say it is important to allocate 20% of the portfolio to gold and diversify your investments. And since prices have considerably corrected at these levels, under-allocated investors can start accumulating in a staggered manner or systematically via SIPs. This would ensure, there would be a sizable upside when the gold prices move higher, and those with adequate allocation, say about 15 to 20%, they can stay put.
Thanks, Ghazal. Next question, George, as we spoke about the IT sector. So its question is related to IT sector only. Is IT sector job creation only the factor? What about the other industries and sectors like manufacturing, etc.? Do we have some data to fill up the euphoria or a bit?
Sure. IT sector is just one indicator. So if you remember, one of the slides which I pointed out was the corporate profitability of the Indian companies. That includes almost 3,300 companies, which are across the sectors. So that would include your manufacturing sector, service sector, and all of that. Then here we are seeing very strong traction in terms of the numbers which are pulled. The blue line which you see, that's a revenue of those 3,300 corporates which are across sectors, and that's showing a reasonably good uptick. So it's not just IT, across industries we are seeing that uptick. So and again in the manufacturing sector, there was one of the slides where I showed the RBI survey of capacity utilization. So even that is upwards of 75% after around 75% after a long time, where it hovered around that 69, 70 kind of levels. So all these kind of indicate there is a robust uptick across sectors, and it is not just IT. IT, of course, there are a lot of near-term noise, but what one should focus is, so there are a couple of drivers which drive this IT demand on a longer term basis. One, an Indian engineer is available at 1/3 of the cost in terms of what an on-site engineer or a US or a developed market engineer cost. And that's one key driver. The second one is technology. The importance of technology is only getting increasing day by day. One, you have a very high talent pool, which is available at much cheaper cost, at 1/3 of the cost. And then the second factor is, the importance of technology, the requirement to have online systems, digital systems to execute your business. That's only going up. So even if you speak to any company which is dependent on technology, they'll vouch the technology spends are never come down, despite you spending a very high amount in a couple of years. The next year something new would come and still the requirement would be there. So despite all these noise, the importance of technology and the cost, as long as we have this, the technology is very prominent and we have the cost benefit, the sector is likely to do well in the long term.
Next question is, all countries have less growth projection. How India demerge from other countries?
See, of course, as the global interest rates move up, you could see some moderation in the growth profile. And the second bigger factor which is impacting is, inflation. If you look at US or Europe, they are at decadal highs, 8.5%, 9% kind of levels, which they have never seen in the past. But compared to that, if we see India, one is, as I explained, a lot of those, the GDP or the growth numbers are driven by the domestic consumption. And the second factor is even inflation in India is at manageable levels. So we are just about 1 percentage points above our RBI's target rate. And we have seen these kind of inflation levels in the past. So one, there is a corporate upcycle which you see in the economy. The corporates are doing well. Even inflation is in manageable levels, and a lot of the domestic GDP is dependent on your domestic production. Of course, a weak global economy would have some bearing in the near term in terms of exports and things, but that's not a very big factor which could derail the economy. Of course, we might see a minor blip in terms of the GDP growth because of weak global growth for a short time, but because of the inherent domestic advantages, as and when things normalizes, you would see that recovery to again resume. So on a longer term basis, like I showed in that long term chart, India has managed to grow at 6.5% despite multiple events in the past, and that's the future is not going to be different in that sense.
So George, in this continuation only, so investor is comparing with our economy with the US one. So the question is, do you think India is decoupled from US market? Like US market is expected to decline by 15-20% further in current level. So what's your view on India basically?
Yeah. See, Indian markets, US markets have already declined by about 19.6-20% in this current year. And India is marginally up. Couple of reasons for that. One, the economic up cycle is fairly strong, and which is very much visible in these numbers, the corporate numbers, and you take the corporate profitability for the entire sector, that's showing fairly robust numbers. And there are factors like IT employment, real estate, which has a ripple effect on many other sectors, and that's keeping up the health in the economy. That's one thing. The second important prominent factor is the domestic flows have been fairly strong. So despite FIIs selling record quantum of equities, so the domestic DII is the domestic institutional investors, which include the mutual funds and the insurance companies. They have pumped in almost similar kind of close to that kind of levels into the market, and therefore the market levels are kind of stable. I think until now there is no sign of these two trends derailing in a big way, and therefore volatility could be there in the near term, but we may not see a very massive drawdown like we saw in the Western world.
This sector specific question, like what are the growth prospects of automobile and realty sector?
So both these sectors look fairly promising. Automobile sector, like I showed in one of my slides, one, demand has been subdued for many years now. And as the economy kind of turns around, when its citizens have more money in its hands in way of more better salaries, better value in terms of their producers and things, you would see their consumption would increase, and that would translate to better auto sales. In the last few years, in the auto sector, what we have seen is, one, there was a demand moderation because of the economic effects. Number two, there were challenges in terms of the chip supply and things like that. Even the supply chain was not in favor. So with the global pandemic, we saw some disruption in the chip supply and things like that. So when both these factors normalize simultaneously, when your supply chain for your input materials would normalize, and number two, we are seeing a cyclical uptick in the economy, and that which would drive the demand. So that makes the auto sector fairly positive from a medium term perspective. And still we have sectors like IT where the predominant crowd is still working from home. So as they start working from offices, start adopting a hybrid model, you would see more requirement for mobility, and that would that points to better prospects for this sector. And another factor is, so most of these companies, they have increased their prices. They have increased their prices over the last few years. Now they are seeing input cost moderation, and that would benefit in terms of their profitability. Along with that, they have all increased their capacities in the last few years, and they're operating at lower utilization levels. So as that utilization level kind of kicking, you would see a larger impact on profitability because of the operating leverage benefit. The second question was on IT sector, right?
Yeah.
Yeah. So IT sector, like I explained before, the long-term trends remain quite intact. One, the cost of an IT engineer in India is a fraction of what we would get in a developed country. And number two, the importance of technology is only increasing day by day. So as the amount of technology which is deployed in the system kind of increases, that itself would create a demand in the subsequent years in terms of maintenance and your requirement to upgrade those softwares and things. So, and that cycle is likely to continue for a very long time. Of course, as the global markets slow down, we might see some bit of moderation, but that would be just a short-term blip. And many a times investors are comparing to what we saw in 2009 or the GFC crisis, the global financial crisis. At that point, the most hit was taken by the banks at that point, and banks are one of the large spenders of in these IT services. But this time, I don't think we would see that kind of an impact in the banking sector. So banks might slow down their spends a bit or moderate, but we may not see that in a big way.
George, it was a reality sector, so you covered IT sector well. But
okay.
You on reality sector.
Yeah, okay. Reality, like I discussed in one of the slides, the affordability is at one of the best times which we have seen in the past decade or almost 2 decades. So as income levels have improved, affordability has improved, we would see a persistent demand for the real estate sector. And there has been reasonable consolidation which has happened in this sector. The regulations have become more stringent. The number of occurrences where the buyer is taken for a ride, that has kind of reduced. And therefore, in terms of confidence from a buyer's perspective, with regulations like RERA, where you can go and complain in terms of if the builder goes against you in a quicker resolution manner, and things like that have made this sector more formal. So all those fringe players have moved out of the system. The sector has become more formalized. Affordability is in one of the most favorable dimensions compared to past many years. With all these factors, the real estate sector is likely to do well, at least for a few years from now.
Thanks, George. Next question is on quantum gold ETF. Ghazal, if you like to answer the same. Why are the volumes in quantum gold ETF so small? Is there a problem on liquidity?
No, in fact, so the investor base that we currently have are actually more of strategic gold investors. Instead of being tactical ones, they come into our gold ETF more from a long-term perspective, from a long-term exposure purpose, and I think that could be translating into lower volumes on the exchange, but I think it's more to do with the kind of mindset and the outlook that our investors have for gold, and that is why it might be perceived as lower liquidity. But in terms of liquidity, there is no issue. We have multiple market makers and abundant liquidity, and we ensure that investors get entry and exit to the ETF at close to market prices. So that is and shouldn't be a concern.
Next question is, which is better, sovereign gold bond or gold mutual fund?
Right. So sovereign gold bonds, they pay an annual interest and are tax efficient. And that is why they have been getting popular. But there is one drawback that they have, which is they have very low secondary market liquidity, because of which it results in price inefficiency. So, for example, if you want to exit the sovereign gold bond before its cutoff period, which is its holding period, which is about 8 years, you have to sell your sovereign gold bond on the exchange, and because of the low liquidity, you might have to you might land up selling it at a discount, and these discounts have ranged from anywhere between 5 to 15%. So that is one thing that investors should keep in mind when it comes to sovereign gold bonds. On the other hand, gold ETFs, extremely liquid. They trade close to market prices, like I mentioned. You can buy and sell on the exchange whenever you want, from the safety, comfort of your home. So this liquidity aspect is where gold ETFs. Both these instruments give you exposure to the prices of gold, but the liquidity aspect is where gold ETFs tend to win over. Also, I would say, so gold ETFs, unlike sovereign gold bonds, are backed by 24-karat physical gold that the fund buys on behalf of the investor and actually sits inside a vault, right? Physical 24-karat physical gold. That is not the case with sovereign gold bonds. They are a sovereign promise. So for many investors, who want that comfort of gold backing their investment, again, gold ETF could be a better option.
Thanks, Ghazal. We have been getting a frequent questions like, the allocation suggested towards our quantum long-term equity value fund is comparatively less. If you see like quantum fund of fund, we are suggesting like 70%. So any particular reason for that?
Yeah. So, George, you can maybe add to that later, but my sense is that, so because value as a strategy can, value and growth as strategies can go through, their ups and downs. What we intend to do here is we have the investor's best interest in mind. I think the only fund house that is asking the investor to allocate bulk of the equity money to the equity fund of fund, which invests in third-party funds, like the investor has rightly pointed out. But the equity fund of fund, through its underlying funds, can give exposure to the investor to different market segments in terms of large cap, mid cap, small cap, and different fund management styles, right? And it, so the fund manager risk gets reduced. Investors can capitalize on the market cap cycles, and also, it's a good diversified to have when you have the value strategy also in your portfolio. So this is my sense. George, would you like to add something?
Yeah, Ghazal is right. So there could be cycles where value is not in favor, growth is in favor. So if you have a basket of funds across different styles, that would ensure a balanced experience across horizon. But it's more of a comfort thing. So if you ask me, So bulk of my money is in quantum long-term equity value fund. So if an investor is comfortable with the value style, he understands these cycles very well. So over a long period of time, value tends to outperform. But over short periods like what we saw between post 2017, 18, 19, periods like that, where there could be phases where global liquidity is abundant, interest rates are interest rates are low, and that you don't see a broad-based economic growth. Periods like that could see value underperforming. If the investor is patient enough to tide over those phases, he can consider a higher allocation for quantum long-term equity value fund. But the reason behind suggesting 15% allocation is primarily to have a balanced experience across time horizon.
Thanks, George. Next question is, how is China +1 policy playing out in India growth story? When are the results going to be visible, and which sector?
Yeah, so with this COVID and the frequent lockdowns which China has implemented, so it's quite evident that manufacturers need to have more than one supplier, and you cannot be dependent on just one country, which is the most cost efficient. And therefore, you would see that across sectors like pharma and many manufacturing, chip manufacturing and stuff like that. So if you look at the government announcements, government has also started introducing the PLI scheme, targeting. So one aim is to reduce our share of imports. And then they have also identified sectors where we can be partners, leaders to other leaders, or at least ramp up our production in sectors like chemical, where we do not have much production. So as part of that scheme, government is subsidizing some portion of the capex as and when these companies scale up for a few years. And as they gain scale and the technology improves, so they should be able to match with the global standards. So China +1 strategy is likely to work, but one other bottleneck is, so if you look at economies like China, they had built massive infrastructure before this manufacturing wave started. As far as India is concerned, we are building our infrastructure, but I'm not sure we have built our infrastructure to a level where that's sufficient for a manufacturing hub. So we would see that improvement, but it could be a little gradual.
Okay. George, which sector Quantum will choose to play in this economic downturn? Any specific sector you would like to name?
So yeah, we are seeing a cyclical uptick in the economy. So our portfolio is more positioned to ride that uptick story in this economy. And that's why we have reasonably high weights in financials and consumer discretionary. And that is visible in the numbers which are coming out. So be it the numbers of corporate sector or many economic indicators, that's visible, and we are positioned there. But following a value style, we always buy companies at a discount to its intrinsic value. So even if there were to be a market correction, so we may not, the fall may not be as high as what we see in the markets, primarily because of value style, where we try to buy companies at a discount to its intrinsic value. So along with value style, we also have a liquidity criteria where we invest only in stocks which has at least $1 million of liquidity. So typically what happens in a market correction is the other fund managers might try to liquidate this liquid portfolio first. And therefore, initial phase, you might see our stocks kind of fall in line with markets. And as and when, once that settles down, since the valuations are quite attractive, the pullback is quite sharp in that kind of scenario. So we are not, at the moment, we are not perceiving a slowdown in the economy, and we are positioned for a cyclical uptick.
Thanks, George. George, we have one more question on IT sector. Basically, Nifty IT index has corrected a lot from its high. What's your advice on investment in Nifty IT index fund at this point?
Right. So I would advise investors to have a diversified portfolio and to invest in diversified funds. The problem with sectoral index is, so the timing has to be very important. So if you are a savvy investor who can time the entry and exit according to the cycles of that specific sector, then you might generate kind of superior returns. But what I have seen with a lot of investors is, so probably they'll buy at a dip and they'll hold on to that for many years. And on a long term, the returns of sectoral index fund, it may not, it would be very similar to what you would see a diversified scheme. So in a diversified scheme, fund manager has the option to identify sectors which are likely to do well. And they would change the allocation based on how the economic cycles and the sectoral developments happen. So my advice would be to invest in a diversified fund rather than an IT index fund. Having said that, from a sectoral perspective, as I've explained in my earlier response, so valuation, in fact, we had trimmed the IT sector some time back when the valuations were at the peak. And now the valuations have kind of corrected. And from a valuation perspective, the sector is quite comfortable now. And apart from that, the long-term growth story, it continues to be strong. So IT from a medium-term perspective as a sector, it is good. But from an investor perspective, I would advise to invest in a diversified sector.
Thanks, George. We have a more tax question on taxation. Basically, balanced advantage funds are treated as an equity fund from taxation perspective. However, quantum multi-asset fund of fund is treated as a debt fund from taxation perspective. Although it varies equity allocation similar to balanced advantage fund. Why the differences?
Yeah, so first of all, the difference in taxation is because, balanced advantage funds, they invest directly in the equity and debt securities, whereas the quantum multi-asset fund of fund it's a fund of fund which invests in other funds for its equity and debt and gold allocations, right? Because of this, there is a difference in their taxation, and multi-asset fund is taxed like a debt fund. And this was a deterrent for investors earlier, but since 1819, when long-term capital gains on equities were introduced, I would say it's pretty much a level playing field now, because if you have an investment horizon of 3 years or more, the long-term capital gains is taxed with indexation, at 20%. And it is important to understand the positive impact that this indexation plays. Because of this indexation benefit, what the investor can essentially do is inflate the cost of purchase based on an inflation index, and then you calculate your gains and your tax. And if you see the tax, post indexation, really it reduces significantly. It's somewhere in the range of 8 to 12%, which, like I said, is a level playing field to equities. So if your horizon is 3 years or more, this debt taxation is really not something you have to worry about.
Yeah. What 3 tips would you give someone who is about to invest their money for the first time?
So first of all, so you should have a long-term horizon. So equity is a long-term gain. You should have a horizon of, let's say, at least 3 years when you invest in equities. So you should not have an aim of doubling your money in 2 years or 3 years when you come to the equity markets. The second most important thing is you should invest regularly. In terms of you have to average out your investments across market cycles. For instance, if I were to look at the 3-year rolling returns for the last 10 years, if you had invested in Nifty, so if you had always invested at the top of the markets, you would have got about 8-9% kind of return. And if you had invested at the bottom of the markets, you would have made about 20% kind of return. But if you had invested at average levels, which is something similar like a systematic investment plan, where you invest across market levels, you would get a like 13% kind of CAGR return, which is a reasonable return. So investors, so when you start investing, you have to invest in a regular fashion, and that would kind of ensure you get a reasonable return. And the third important point is, to follow an asset allocation strategy. So if you are 100% equity investors during times of, let's say, market drawdown, or you had an emergency when markets were at its bottom, you cannot liquidate your equity funds at a loss, and then that kind of disturbs your experience. And that is a reason we advise investors to follow this 12-20-80 rule, where you keep 12 months of your monthly expenses in a very safe liquid product. So even if you have some kind of uncertainty, you can hop onto that 12 months of emergency fund, and your long-term asset allocation framework of 80-20 between equity and gold will give you a reasonable return, where your risk is also managed. So if you include 20% allocation in gold, that would ensure even when equities are not doing well, your portfolio does not suffer in the same extent, because gold tends to work in a contra fashion. Like when equities are doing badly, the economies are going through a lot of uncertainties, gold tends to hold up. So one is to have a long-term horizon and stick to your asset allocation plan for the long term. You can even use our website to identify your potential requirement of how your portfolio currently looking and how you need to rebalance to get onto that 12-20-80 kind of allocation.
Thanks, George. Now, question comes back to our value fund. We have seen a long underperformance of our quantum long-term equity value fund. So what are the reasons for that? And what are the corrective actions we have taken to build up the performance?
Right. See, last 5 years has seen was not a very great experience for quantum long-term equity value fund investors. The initial part of the 5-year period, if you see, growth stocks did phenomenally well. If you had a slightly better growth, the companies used to command much higher multiples, and which does not augur well in terms of QLTV of strategy. So that was one reason. And if you look at, so let's say if you take the last 5 years, in 2017 was one of the years where we saw a massive underperformance. The reason being, when the market went up, so we kept on selling the stocks since the valuations had reached our sell limits. And since markets were not cheap, we were not able to buy into new stocks. So in the last, since around COVID time, we kind of realized a couple of mistakes which we were doing. One, so our sell limit is based at the intrinsic value. So even after we selling the stock continued to rally for a long time, the trend was positive. So we decided to sell in a staggered manner. So we would probably sell some portion of our holdings as it reaches sell limits, and kind of exit completely as and when 10% above sell limit, 20% above sell limit. We have set a process in terms of that quantum to capture a slightly better upside of those stocks. So the other thing which we noticed was a lot of our stocks, a lot of quality companies were coming close to our buy limit, and then it kind of reverses that trend. So just by few percentage points, we were kind of missing a few opportunities there. So we have decided a process wherein we would start a portion of that allocation at a level something like 10% above the buy limit. And then as and when the stock corrects more, we will add more weights to that stocks. So this is applicable only for a few quality companies. And with that tweak, we were in fact able to get few quality names around that COVID time into the portfolio, which has done phenomenally well. So with these two with these two tweaks, you will not see companies, wherein you sell out very early in an improving trajectory phase, and you fail to buy, companies since markets continue to be expensive. So one, since you have a leeway to buy a stock slightly above the buy limit, if it's a high quality name, that would ensure you have more names into the portfolio. And since you're selling in a staggered manner, that would ensure you capture more of the upside. So those are a couple of tweaks which we did. And another important parameter which we kind of fixed is, so we had one of the companies which went through a balance sheet risk, and we continued holding on to that company, and we had to sell it out in a large loss. So companies like that, if the stock corrects by a certain amount, and then if we still see a balance sheet risk, in spite of the catalyst or our likely thesis, we would exit those kind of names. Where we see a balance sheet risk, and because of that reason, the stock kept on correcting. So with these tweaks, I feel going forward, we should be able to add more names into the portfolio, and the portfolio would have, when you have more number of names and you capture better upside, you would see that gap reducing going forward. So one of the other favorable tailwinds is typically when there is a broad-based economic recovery, value tends to do well, because it's not just the few growth names which records earnings growth. So the broad-based, a lot of companies would report growth, and that would reflect in your share prices and multiples. And even that would favor the performance in 12TBF going forward in a rising interest rate scenario, and when we see a cyclical tick in the economy.
Thanks, George. Next question is on our ESG fund. Our ESG fund has outperformed the benchmark for over 3 years. Do you think this outperformance will be sustained going forward?
Yeah. So if you see the portfolio of the QESG fund, we have all quality names, and most of them are sector leaders, and of course that has translated into the outperformance that we have seen, clearly because like we believe, and there is growing evidence of this, that there is a strong correlation between sustainability and profitability, right? In terms of lower input costs that the company could enjoy, lower costs of financing, they would attract better talent, there would be lower risk of regulatory actions or penalties or consumer boycotts and backlashes. So, I mean, sustainability is what is going to be the driver of profitability in the long term. So yes, we hope and we believe that this outperformance will be sustained going forward. And also, I mean, each of these parameters of E, S, and G are, coming to the forefront. They are becoming more and more important slowly. I mean, of late, if you see the environmental challenges the world has been seeing, the droughts, the floods, heat waves, attention towards ESG, I think because of these kind of developments is growing, and we believe ESG investing is the future of equity investing.
Thanks, Ghazal. Ghazal, there is one more question on our liquid fund.
Yeah.
In the backdrop of rising interest rate, why should one choose liquid funds over bank FDs?
So I think two simple reasons for that. First of all, transmission of interest rates is slower in bank fixed deposits. As in, if interest rates go high, the transmission will not be immediate when it comes to bank fixed deposits. It will happen, but with a lag. Whereas in liquid funds, because we're invested in such low duration and such liquid instruments, we know that your money will get redeployed as and when these securities mature at those higher interest rates. So the benefits of high interest rates will transmit faster in the case of liquid funds. So that is the number one reason why you can consider liquid funds over bank FDs. And also because bank FDs, as we all know, come with lock-in periods, whereas liquid funds can offer you, the ready liquidity. So if that is what you're looking for, that could be another reason why you should choose liquid funds over bank FDs.
Thanks. There's one question that like, do one require demat account for investing in quantum multi-asset fund or value fund? The answer is no. Demat account is not mandatory to invest in any of our, to invest in our quantum multi-asset fund and value fund, basically. George, there's one question on our quantum tax saving fund. Like, it's basically a strategy difference. Is there a difference in strategy between our quantum tax saving fund and quantum long-term equity value fund?
No, both the portfolios are essentially same. The only difference is quantum tax saving fund can hold a maximum cash of about 20%, whereas QLTVF, the quantum long-term equity value fund, can go up to 35% cash. But we are at much lower levels. We are not nowhere close to any of these limits. So the only difference is quantum tax saving fund. It comes with a 3-year lock-in period, and therefore, so you can consider that for your ELSS requirement. Also, ever since we have seen this economic uptick in the current cycle on a YTD basis, quantum tax saving fund has come up in something like the first quartile of among all its peers. So it's just a similar strategy. The only thing is, it has a 3-year lock-in period because of the ELSS nature.
Thanks, George. George, there's one question on our global fund. In past, there was some discussion around quantum coming up with some funds for global exposures. By when we can expect that? Meanwhile, it would be good to include the global fund in quantum equity fund of fund. What's your thoughts on that?
Yeah, I'll take the first part, and maybe on equity fund of funds, Ghazal can comment.
Sure.
So that's so we have been working on that product. That's still on the. It has not been finalized. Once we finalize the strategy, we'll come to you. So we are working on that product, but that the finalization is yet to happen. Ghazal can comment on its inclusion in the fund of funds.
Yeah. So the equity fund of fund, actually, the mandate is to provide investors a one-stop solution for domestic equity exposure, and diversified equity funds with good track records, consistent performance. That's the agenda when it comes to the equity fund of fund. So we will leave the global allocation to hopefully our global offering that should come soon. So yeah, that's my comment on that.
Well, there's one question. Can you explain in detail about ESG fund?
So like I spoke about it, so instead of companies that are just focused on enhancing their profitability, ESG, environment, social governance, these 3 things are increasingly becoming more and more important for businesses to take into account, for businesses to kind of respect if they want to continue to stay in business, if they want to not face any regulatory backlashes, or if they want to enjoy the confidence of consumers, because we are seeing that consumers are becoming more and more aware about these environmental degradation that businesses tend to do in this chase for profits, or they don't tend to treat their employees or their customers well. So that's the social aspect. Or if they're not run in an honest and transparent way, that's the governance aspect. So slowly consumers, investors have started giving value to these things, and that is why in the future, companies that do not pay respect or kind of adhere to these 3 parameters might lose out in terms of maybe the consumer not opting for their products, or if more and more regulations come around these things, it's going to be costly if they are not following these things, and then they will be forced into following it, and that could come at a cost, financial cost, or a reputational cost. So all in all, ESG, even though it feels like to the investor that these are non-financial things, and why are we considering them when we are investing our money in businesses, these these are seemingly non-financial, but let me tell you, these non-financial things actually have a very tangible financial impact on the business, and that is why it becomes important to kind of consider this. So this is what the ESG fund is working with. We're trying to identify good businesses which are financially stable and which are trying to really improve their game or improve their work on the E, S and G front, so that we can select the winners of tomorrow, the stocks or the companies that will kind of benefit from this whole transition that we're seeing towards more environmental consciousness and businesses with values per se. So that is essentially what the ESG fund is trying to do, because this focus will ultimately result in good long-term returns for the investor.
Thanks, Ghazal. There is one question. Do you have any Bs fund like Nifty Bs or others, something like Nippon Bs?
So the gold ETF is an exchange traded fund. So that is the units of that trade on an exchange. So like the Nippon Bees fund, I think they also have other ETFs with that name. So our offering in the ETF space is the Quantum Gold ETF and the Nifty ETF, which invests in the top 50 stocks in the top stocks, the stocks of the Nifty 50 index. So these are our offerings in the ETF space.
Thank you. There is a question on NRI. Basically, can NRI invest or directly to mutual fund?
Yes, NRIs can invest directly into mutual funds, just like any other investor. There is no restriction unless it's a US citizen. There is no restriction as such.
Okay.
Neeraj, you want to add something?
No, so only US and Canada at the moment cannot invest. There's a restriction for US and Canada people, but other than all the NRIs can invest having the PAN cards. So one question is on the cash level, John. Does the fund take a calls on cash level depending upon the market outlook?
The cash is a derivative of the process which we run. So the typical process is when a stock comes to our buy limit, which is typically at a discount to the intrinsic value. So the stock finds its way into the portfolio. And as we feel the stock reaches its intrinsic value, which is the sell limit, that kind of exits the portfolio. So the cash is a derivation of this process. So typically when the market valuations are cheap or when we see good prospects on a 2-year forward on a futuristic basis, you would see the cash levels could be lower because we would get more opportunities to buy. We will find more stocks which are available at a discount to fair value. And that would be the times when you would see the cash levels are low. If the markets are trading at very exorbitant valuations and where we feel most of the positive news is priced into the stock, we would start selling our stocks and that would result in higher cash levels. So we don't take a call on the cash levels depending on the market outlook, but it is just a derivative of our process. And we follow this process with a very disciplined style, and that has ensured sustainable performance over long periods of time. And cash is just a derivation of our process.
Thanks, John. There's a question on liquid fund. Is liquid fund better than FDs?
Yeah, I think I answered that. There's nothing like, which is the better avenue. You can always, whatever you're more comfortable with. But what I think the question was to do with, interest rates rising. And what I felt was, and I think I read in the comments, what is transmission of rates to FDs? What I mean is when the central bank increases or reduces its interest rates, the banks for their deposits or for their loans also have to increase and reduce their rates in accordance with it. But that, generally tends to come at a lag and tends to be, not in the same quantum. Right. So in this particular scenario where interest rates are rising, I believe, liquid funds can give you those higher interest rates faster. That's what I mean by transmission. So, you can enjoy the higher interest rates in liquid funds. That was the point I was trying to make. And also, again, if you are comfortable with bank fixed deposits, and they tend to have lock-in periods of 3 to 5 years, you can definitely go ahead with that. But if it is liquidity that you are looking for, then liquid funds can be a good option.
Jude, what is your expectations in the market for next coming 2 to 3 years or 4 years?
Yeah, so like I explained in my presentation, so India, after a very long period of tepid growth, which we saw prior to 2020, we believe we are at a stage where economic recovery is in place, and all the economic indicators are indicating those kind of signals, where those signals are only getting stronger and stronger month after month. And therefore, from a next 2 to 3 years perspective, we believe economy is in a good shape. Of course, there could be a minor blip if we see a global event and if there is if the global scenario worsens. But we should quickly catch up because the recovery cycle is quite stable to that extent. So from a 2 to 3 year expectation, we are quite positive on the economy, and that should reflect in the markets as well.
Thanks, George. Last question for the day. Ghazal, it's on multi-asset fund basically. Since quantum multi-asset fund of fund, is it expensive in terms of charges when compared to a normal equity or debt fund?
Yeah, so fund of funds typically are criticized for having 2 layers of charges. That is the charges of the underlying funds and the charge of the fund of fund itself. But in spite of the 2 layers of charges, I would like to highlight, that the total expense ratio of the quantum multi-asset fund is only 0.54%, so 54 basis points. The weighted expense ratio of the underlying schemes is 44 basis points, and charges that we take for operating and managing the quantum multi-asset fund on your behalf, for providing this ready-made asset allocation solution to you, is just 10 basis points. So a total expense ratio of only 54 basis points. So as evident, I would say the fund charges, very nominal fees for operating the fund, in addition to researching, selecting and monitoring the investments. And I think investors should consider this fund because they end up, getting professional expertise and research-based approach to asset allocation, that is convenient and also, at a marginal cost.
Thanks, Ghazal. I think so we can take a last question. George, it's for you. Just your view on your small cap funds in coming few years.
Yeah. So the trend which we have been seeing with GST and demonetization, so if we analyze the economic data, it shows the larger companies are gaining market share and the smaller companies are losing market share in their respective sectors. So with that, from a broader level, the smaller companies are likely to perform in an inferior way compared to the large caps. But there could be pockets or specific opportunities where where leaders would emerge and you might see a superior experience. But from a broader perspective, with all the formalization of the economy and what has the changes which has happened in the economy, it looks like it's more favorable for the larger companies.
Thanks, George and Ghazal. With this, we'll end our Q&A session. Any closing comments from you, George or Ghazal? Yeah, so we have been hearing a lot of noise in the global environment, but probably, as I explained in my presentation, India is in a different stage of the economic cycle, and therefore
we could expect a fairly strong performance from an economic perspective in the near term. A near term or even for a 2 to 3 years perspective. And of course, from a long-term perspective, India offers reasonable growth potential at about 6.5%, like I explained, and that would translate to reasonable returns in an equity. Investors should stick to their asset allocation plan. You should have a liquid portfolio which would cater to your monthly expenses and allocate the rest of your portfolio in a 80-20 fashion between equity and gold, so that you would have a balanced returns across cycles. And you should invest in a continuous level so that you enjoy the benefits of long-term compounding and the benefits of the average levels of market. You can use our website to decide on your asset allocation in terms of inputting your current allocation. That would suggest how you should tweak your allocation to that extent. Ghazal, over to you.
So I definitely agree with George, and I started this webinar with 2 words, asset allocation. I'd like to end with those 2 words, asset allocation, because, you know, when one asset class is doing well, we all tend to become a little complacent. We want those higher returns. We kind of get greedy, but, you know, time and again, external shocks come in, and, you know, that's when we see investors rushing to gold, you know, in times of those stress and crisis. So and then they start discounting it again, you know, when the dust has settled. So I think we should all appreciate that there are risks lingering on the horizon, and gold and specifically asset allocation can really, you know, help you thrive amid those. So yeah, those are my final thoughts. Thanks.
Thank you, George and Ghazal, for your valuable comments. To know more about our 12-20-80 solution, we'll request all our listeners to visit our website, www.quantumamc.com. Also, further, for any questions to be answered, you can write to us at customercare@quantumamc.com, and we will be happy to answer the same. Once again, thank you everyone for giving your valuable time. Stay safe and happy investing to you all.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.